Beware. Democrats want to eliminate step up in basis. In this episode, I'm going to address the question, what is the step up in basis on long-term capital gains? Because I fear sooner or later it's going to go away, especially if Democrats get their way in order to raise tax revenue to fund some of their initiatives. So put on your seatbelt. I'm going to show you how important it is to understand this, especially if you might inherit some assets from your parents. So I'm Doug Andrew. I've been a financial strategist, a tax minimization specialist now for more than 46 years. I've written 11 books so far, and I have a goal to write a book every year the rest of my life. If you stay with me, I'm going to show you how you can get a free copy of my most recent best-selling book, The Laser Fund, 300 pages. I'll gift you a copy of that book. But let's cover what a step up in basis is, and then I'm going to show you how impactful this will be if they do away with what is called a step up in basis on long-term capital gains. So I'm going to go over here to the whiteboard and give you a few examples here. This could relate to real estate, rental properties, commercial buildings. It can also relate to stocks. So let's say that your parents purchased some investments, whether it's stocks or real estate. Their purchase price, let's say, was $250,000 10 years, 15, 20, 30 years ago, 50 years ago. See, that's what you put into the investment. That's called your basis. Many times if you buy a piece of property and you end up paying this amount for the property, but let's say that at the time you did it, only 40 or 50,000 was the actual land. The rest of it was the building, okay? Well, you can depreciate down the building, and so that gets rid of some of the basis. It means that you are depreciating that. It's a tax write-off, which is actually pretty good. If you own rental properties, there's three big deductions you can take. The depreciation on the property over 20 to 30 years, you're depreciating it down just to the value of the land. But then you have also any mortgage interest, that's deductible, but then also maintenance and repairs. The combination of those three deductions means usually you have a loss that carries forward and helps you with tax benefits on your tax return. Well, those are all recouped when you sell it. Because let's say the $250,000 property goes up in value to $1 million. Now, this is really realistic, because in real estate, if real estate appreciates at 5% a year, it's going to double every 15 years. If it appreciates at 7%, which many areas do, it's going to double every 10 years. So in 10 years, it doubles to 500,000, and in another 10 years, at the end of 20 years, it's worth $1 million. This happens on people's personal residences. Now, sometimes I have my son's in-laws, they bought a home for $230,000 in the San Francisco Bay Area years ago, and they raised their 6 children there. And you can add to the basis because of improvements or additions. But do you know that about 30, 35 years later, they sold that for $4.6 million? Now, that's called a long-term capital gain. In a nutshell, you do get some exemptions, or you can have up to $500,000 if you're married of capital gains every time you sell a house, or if you're single, it's $250,000. But let's talk about non-owner occupied rental income real estate or stocks or anything like that. See, that's called the gain. That's called a long-term capital gain if you've had that property for more than a year. Now, depending upon who's in office in the executive branch and also Congress, you can sort of tell who likes to have the highest taxes. And so usually when Republicans are in control, the capital gain tax rates are around 15 to 20%. At the time of the recording of this, the capital gain from a federal level is 20%. When Obama was in office, to fund his Obamacare, as it was called, okay, there was an extra 3.6 or whatever. And so many times you have another 6% on top of that. And so 23, 24% is the federal rate. Now, most states have also a long-term capital gain rate. It could be 5% or more, what have you. So you're paying tax on your property simply appreciating in value. I think it's an unfair tax, frankly, because you're paying tax for inflation. Because sometimes that's going to happen regardless, and it's just inflation, but you're having to pay tax on what the inflation rate was. I think that's sort of unfair. But the government, they're hard up for tax revenue, right? Well, sometimes when we have the Democrats in control in the presidency or in Congress, they want to change the capital gain tax rate, long-term capital gain, to the ordinary income rate, the regular income tax rate. At the recording of this, right now, under the Trump tax cuts, the highest is 37% for federal income tax. When those Trump tax cuts expire or change, it will go back up to the 39.6% federal rate. Okay. Now, in an election year, you will hear the delegates, you will hear the candidates for president talk about what they plan to do. And Joe Biden, with the Democrat Party, he wants to even do more spending with health care. And he says it's going to cost $750 billion extra dollars. And of course, what do they ask him? Where are you going to get the money, Mr. Biden? And he disclosed he's going to take the federal tax rate on long-term capital gains from this to this. Now, 20 up to nearly 40 is double. But he said, I'm also going to get rid of the step-up in basis. So what's the step-up in basis, and how does this affect you? So people don't like to pay unnecessary tax any sooner than they need to, and frankly, I agree. So most people like to postpone or delay the inevitable, paying capital gains tax, so they hang on to the asset. If it's stocks, they just hang on to the stock. If it's real estate, they either hang on to it to avoid paying a capital gain tax, or they do a 1031 exchange. In real estate, that simply means if I sell a rental property, a piece of real estate, and I have a gain now because the basis was $250 and I've depreciated it down and I'm selling it for $1 million, or like these people, $230, $4.6 million. Instead of having to pay a capital gain tax, even here at 23% plus the state rate, people pay as much as 30%. My heavens, they'll be paying as much as 50% when you add the state capital gain rate on top of this, if Joe Biden were to get his way to do this, okay? And so what happens is they don't want to pay that tax because it's 30, 40% of their money. So they do a 1031 exchange. They sell their property. They cannot touch the money. It has to go to a third party in escrow. And then they buy a like property. And if they qualify, then the capital gain continues to defer. You're doing a 1031 exchange. The money goes into the new property. And as you do that, you continue to defer having to pay a capital gain tax. Now, why do people do that? Frankly, sometimes they wish they hadn't done it because it's like going from the frying pan to the fire, or they're just trading the last headache for a new headache because they still have to be a landlord, evicting tenants, taking out trash, fixing toilet. And it's amazing how many people don't go, why don't I just bite the bullet and pay this and take the net and put it into a portfolio of my favorite financial instruments. I call it the laser fund, max funded, tax advantaged, indexed universal life insurance contracts. And people are like shocked. They're getting 7 to 10% tax-free cash flow. That every million generates 70 to 100,000 a year of tax-free income, which is as good or better than their real estate was doing. And they go, wait a minute, I don't have to fix toilets, evict tenants, take out trash anymore. What am I going to do with my time? Like, go enjoy life. You don't have to be a landlord and you can get those same rates of return. But some people go, I don't want to pay the tax. So they defer it because the law says that whatever it's worth down the road, if you die and you leave that to your children, they get a step up in basis. If you give it to a charity, the charity gets a step up in basis. Meaning, if it's worth $4.6 million when you die and leave it to your kids, They don't have to pay the capital gain. Now the basis goes up. It's stepped up to 4.6 million. The children only have to pay capital gain tax on what they sell it for when they sell it, over and above this, not this. Democrats say, let's get rid of that. That when you die, you will pay the heirs, or if you're alive, you will pay tax on the full gain. You don't get a step up in basis. And it won't be at this rate. It'll be at double that. This is where they plan to get tax revenue. You know what? I think there's a lot of people that have assets that have appreciated a lot, that they were counting on that step up in basis. And they may be tempted to make an appointment with someone like a Dr. Kevorkian to hurry and die before that goes into law. You know how many billions of dollars that's going to cost Americans to help out these initiatives that, frankly, I think we could fund in other ways, or let people take ownership in their own retirement? Hey, if this is even slightly resonating with you, you want to learn and protect yourself and do what I alluded to, something far better than maybe thinking I'm going to keep postponing and hopefully get a step up in basis as I transfer and buy new properties, or my kids inherit this, because it looks like sooner or later it's going out the window. So protect yourself. I would love to gift you a copy of my most recent best-selling book, The Laser Fund. Laser means liquid asset safely earning returns. This 300-page book will empower you to learn how to diversify and create the foundation for a tax-free retirement, to be able to earn rates of return of 6, 7, 8, 9, 10%. Every $1 million can generate $60,000 to $100,000 a year of tax-free income for as long as you live, which frankly outperforms a lot of real estate investments or stocks. And so this is actually 2 books in one. This one is the Left Brain Charts, Graphs, 200 pages, 14 chapters. If you learn by stories, read this one. This is 12 chapters, about 100 pages, 62 actual client stories. If you simply go to laserfund.com, you click on the link below, or go to laserfund.com, you simply pay $5.95 shipping and handling. By the way, that doesn't quite cover the cost of shipping and handling, but I want to gift you the book. I'll pay for the book, you pay the shipping, and then there's options there to listen and learn, watch and learn through videos and audios and so forth. But this will help you learn about these kinds of tax strategies and how to protect yourself and preserve what you've worked so hard to accumulate. And the accumulation was primarily a function of inflation. Why should you pay tax on inflation? Don't do it.